Good morning, ladies and gentlemen. Well, we have the FOMC next week, and our model score remains stubbornly negative. Now, I've looked at why that is, and really we started going negative on the 24th of April this year, and I think that this is the problem. This is a chart of SPY TLT, and don't forget this is a relative model which says what should one be investing in, equities or cash or the equivalent basically in bonds. And here we are, this is when it started to go negative and say there are problems in the market. And SPY TLT is below that level. And also ITOT government, which is the totality of the bond market, but unfortunately it's not weighted. And this is where we started to say there is trouble relative to bonds in stocks. And we are very much there, right, within 1%. What is this telling me? This is telling me that either we go into a complete regime change in which stocks get sold against bonds, or we go the other way. But we are on the cusp of something very interesting, and this somehow does tie in with what the Fed is going to do, because I believe that whatever the Fed does now is going to have very important consequences, because it has to show the market what and how they're thinking about the economy. So let's cover the FOMC and see what the consequences of the dot plots and the summary of economic projections will be. Far more than the dot plots, I'm interested in these economic projections. Why? Because whatever they do, whether it's a 25 or a 50, and you know that we are at 50% probability of either, it has to be I would have thought, unanimous, or with not many dissenters, say one or two maximum, and it has to be consistent with what they put down for real GDP, unemployment rate, and PCE inflation. At the end of the summary sheet, I've given you a link to what Gundlach thinks about inflation and how he thinks about inflation. I think it's important that you should watch that video. I agree with him that probably inflation is falling faster than the market is thinking about it, or how it's thinking about it. So core PCE inflation has to be significantly lower than their projections for 2025. Don't look at 2026 anymore. Don't look at 2024 anymore. I think 2024 is basically baked in. Whatever happens, because of base effects, it really can't be very different. What you're looking for is 2025 and 2026. I think it's possible that they reduce PCE inflation from the 2.3 that they gave us in June quite substantially. And I think it's also possible that they lower or keep constant the GDP and raise the unemployment rate. That can be consistent with a 50. Okay, that can be consistent. High level point here is that if they were to do a 50 and not change these projections, that would actually frighten the long end. So you get a real yield curve steepener. Let's basically summarize what I'm saying. I don't care whether they do a 25, and I don't care whether they do a 50. But if they were to do a 50, they have to lower the PCE, they have to probably lower the GDP, although that's not so much what I'm concentrating on, but they also need to hike the unemployment rate. They have to be consistent. They can't just say to the market, we are cutting 50 for no reason. That is the high level point, and that is what I'm basing my trading assumptions on. What they do here in these dot plots, I really don't care about. I really don't care, because these are just guesses. And their guesses are as good as anyone else's, probably as good as a monkey with throwing darts. What I would like to see is a convergence of these plots. Okay, so this is the 2025 one. The 2026, 2024, I really don't care whether they have it down here, up there. Nobody really minds anymore. These are the ones that need to come in, and probably we need to be below 4%. 350 to 375 to be able to justify a 50% cut. Why? Because if they give us a 50 now, the market will be screaming for a 50 in November, and it'll be screaming for a 50 in December as well, which basically means 150 over the course of the next, let's call it 3 months, which takes us down to the 375 to 4% area. That is really as far as we can go, and that's what the market will price. It'll price immediately another 250s. If, like me, you believe that the bond market is actually reacting to inflation normalizing and PCE going down to 2% target, or even below target because of commodity prices, you then don't need a lower GDP, and you don't need a higher unemployment to believe that the curve is normalizing and that real rates are coming down towards a 1.5% level. That is just normalization and a yield curve which is normal. Don't forget that a lot of people forget that a negative yield curve is abnormal. It only happens during periods of stress, and a return to a positive yield curve is the most normal thing in the world. The only question then becomes is how positive is the yield curve? During a period such as this, when we have extremely high deficits, and there is absolutely no chance that these deficits will go down, but it's only a question of how fast they will rise should there be a recession, because should there be a recession, the deficits are really going to go a lot higher than they are now. The question becomes, how steep should the yield curve be? The yield curve will basically react to how quickly they cut rates and why they're cutting rates. If they're cutting rates with no reason, i.e. no justification of a lower GDP, a higher unemployment, and an expectation that PCE is at target or below target, then the yield curve will be considerably steeper. Let's have a look at where we were in 2s10s, basically in a period of nothing much going on. 2019 to 2020, the whole of 2019, 2s10s were in this range, and if they cut 50, I think 2s10s can easily go back to this range. Now we're at 7 basis points, we can go to 27. So we can go to another 20 basis points of steepening in the 2s10s, trade around, wait for the 200-day moving average to catch up, and then go down. If they only cut 25, but they do also lower the projections for GDP, increase unemployment, then you will probably get much more of a parallel shift down in the whole yield curve. And that will be good for 10s, it'll be good for 30s, it'll be good for absolutely the whole of the bond market. And it should be a negative for equities. So that chart I showed you earlier of ITOX over government, you will probably start seeing the first cracks in that chart, and the market will be turning in favor of bonds and against equities. But I don't think we're there yet. I think it's going to take a long time. The high level point here is the more they cut with less of a justification from the summary of economic projections, the steeper the yield curve. Okay, so let's have a look at the individual components of the yield curve. This is the 2-year note. If they were to cut 25 basis points, would the 2-year really mind? Answer, no. I think it might move back to this kind of level, the 268, but there would be a whole load of support there. So don't let anyone tell you that, whether they cut 25 or 50 makes a hell of a difference to the 2-year note. No, it really doesn't. It'll be disappointed for about a day and a half, and then it'll go again. We are in a bull market for the 2-year note. There is absolutely no question about it. Prices are going up. If the 2-year note goes back up to 268 and the 10s don't do anything, that is a great outcome for the Fed, because what they care about is mortgage rates. They really could not care less whether the 2-year note was 258 or 268. Why does that matter to anyone? It's not like if they cut 25 or 50, it's going to make any difference at all to the credit card rate, which is 25%. What are they going to do? They're going to bring down credit card rates? No, they're not. They're going to keep them there for months on end. So the 2-year note price to them should be irrelevant. The Fed should care about 10s and 30s, and it should care about where they are and how quickly the mortgage rates can come down if they are worried about the economy. And if they're worried about the economy, they have to show that in the summary of economic projections. They have to show it in their expectations for unemployment. They have to show it in their expectations for growth. Otherwise, the long end just takes fright and says, what, you're cutting 50 for no reason whatsoever. You have not changed your projections from the last time, but you're now doing a panic move. Why? What do you know that we don't know? And basically the 30s take fright and they go back up. They have a lot of reasons not to go down, i.e. the deficit, the issuance, etc. But if they believe the Fed and that inflation is coming down to target, and yes, we might be having some difficulty with growth, etc., then the 30s can slowly start coming down towards the 375 area. Don't forget, we have very high at the moment, relatively high, real rates. Are they hugely high? No. 255 was high. 160 something is not enormously high, but it's still a lot higher than the Fed would like them to be if we are going to go into even a growth recession, i.e. if we're going to have very mild growth and inflation anywhere near their 2% target. Why would we not have real rates at 1.5%? 1.5% real rates would give you around, 3.5% on 10s. Is that a million miles away from where we are? No, it's not. But it's down here, right? With at these lower levels where we're trading the whole of the beginning of 2023, why not return there and basically use 340 or something like that as the median and go sideways for many, many weeks and let the yield curve slowly steepen, but don't let it steepen very fast, because that is not good for anything. It's not good for any asset market. A steeper yield curve and a disinversion of the yield curve brings volatility, and it'll bring more volatility to the equities. High level point, what I expect is 25, but I expect it to be a dovish 25, i.e., that they are going to say, we are watching the data very carefully and we will move very hard if the data warrants it. That makes sense to me. I don't think that would worry the long end at all. The short end might go back 10 basis points on the twos as a sort of knee-jerk reaction, but it'll recover that in no time whatsoever. So to do a 50, you really need some data to change in the summary of economic projections. And if that doesn't happen, then it's just an outright steepener. And you don't lose the long end, but the long end does not like it. And what did the German Schatz do when they cut 25 and it was a hawkish 25? Nothing. Right? And this is exactly what I expect the US to do. The Schatz went from 216 to 225 and basically back. There is absolutely no reason to expect that the 2-year would get very upset by only a 25 basis point cut. It would trade 10 basis points higher and then 8 basis points lower. So I really don't see what they get by cutting 50 now, apart from sending a stupid signal to the market. They really would need to say that they expect unemployment to be substantially higher to justify a 50. But, what do I know? I know that I will be steepening the curve and I will be going for steepeners unless they show me that they expect the economic conditions to be significantly worse than they are. So, end of story. That's what I will be doing. What can I say about Germany? Nothing. It's doing exactly what I think it needs to do, and that is a period of sideways. 10-year notes, I think they will try this 221 and eventually break this 208 to 207 area. And I think that their ultimate destination is between 190 and 178. That is where eventually the market gets to go. And I think that just like the US, the 10-year note is going to remain stable for a while at those lower levels. And only when we see definitive proof that inflation is even below target can the 10-year note make substantial moves lower from these levels. And I don't think that happens for a while. I don't think that happens for months. And therefore, I think that we are in this kind of range with a downward trend. And really, the best strategy is to be long, but to sell calls against it, out of the money calls, because I think the move down is going to be very, very gradual, and it's really not going to change by more than 1, 2, or 3 basis points per week. This is a chart of twos, US, Germany, and as you can see, it's leading quite strongly. I think we settle around this 130 area for the time being, which also tells me that every time the 2-year note backs up in the US, you're supposed to buy it. We are in a trend. And the interesting one is actually US 2s against Germany 10s. You can see where we are on that, and basically we are in a period of COVID. It's going to hopefully stop around here and trade around, which tells me that actually we're going to have some parallel yield curve shifts in the US, but I'm not going to put a lot of money on that, but what is interesting is that tens are around 152, and that is giving no signal. Just because it's 1 basis point through something, it really doesn't mean anything. But I do believe that this chart slowly is going to normalize, and we are going to trade down to these levels. And if we look far enough back, we can see that really this is the kind of median area that spread likes to be at. So really around the 125 to 1% area should not surprise anyone, which tells me that the bonds are in a bull market over the course of the next 6 to 9 months, and that they will slowly go up, and this differential in everything is going to narrow. And I believe that that is consistent with inflation down to target or even below target, commodity prices remaining weak and enabling that to happen, and an economy which slowly has a growth recession, and where it probably pays to be long of bonds over equities. Does that mean that I think equities are going to go down 10%? No. It just means that I think that bonds are going to, for once, do better than equities for a while. From my view of the differential, you know my view of the dollar. It should weaken over time. I know that we are on a 200-week support. I know that the Bollinger Bands are here on the weeklies, and I know that it's very difficult for the market to be below the Bollinger Bands. But if we say that the Fed only does 25 and the market is slightly disappointed, and we get a move to around here, 102.50, some sort of ABC 102.50, to me that's a sell. I will be buying puts there on the Dixie, or rather I will be buying calls on the euro. I think those differentials are coming in, and they will come in fast. So what am I saying on the euro? You get a move probably down to this 109.50, 60 area, and I think that you are supposed to buy calls there for a return towards 112. I can't see anything else that fits, so at 25 would be disappointing for the dollar bears, as it were, because they're now expecting almost 50. And if that happens, then you get to buy better levels. If they do 50, I think the dollar goes straight back up to this, 111.20 level and tests it. I don't think it breaks for the time being, but certainly I think you want to be long of currencies against the dollar in either way. If they do a 50, it's a panic move, and you want to be looking to sell them up there if you can buy them anywhere cheaper. And if they do only a 25, only in inverted commas, and the market is disappointed, you really want to load up around this 109.80 with call spreads. Gold, I think, has a lot more to do with the Russia-Ukraine situation and the geopolitical tensions now that the US and Great Britain have allowed the use of their long-range missiles within Russia itself, and the fact that basically Putin has said that he sees that as a declaration of war against Russia by NATO. And you never know what kind of nutty things the Russians might do as a result, and how silly they can get. So I think gold prices have a lot more to do with that than with how much the Fed will cut, whether it's 25 or 50. I think that's really immaterial to gold. So being in a geopolitical situation, how long is a piece of string? We are going to be waiting for the Russian response, and that could be anything or come at any time. How do you play gold? Well, you can only be long of calls, can't you? Or you can be long of the underlying and be long of puts. Because if the Russians don't do anything, which is, more than 50-50, it comes back, right? It comes back certainly to test the moving averages, which are around the 2500, 2550 to 2570 area. What can you say about it? Not a lot. It's definitely a bull market. It's definitely going up. But you have to have some protection because if nothing were to happen, it'll definitely come back $100 at the speed of light. DBC is still below 21.75, although prices of oil recovered slightly. What does this chart tell me? It probably tells me that it fills this gap up to 22.05, gets everybody bullsed up. Again, we might get to 22.38, and then it just sort of, after 3-4 weeks, these Bollinger Bands finally open up, and we have an almighty dump down into the end of the year. This chart, which is gold against commodities, is one way. It's pretty obvious to me that we will trade 1260. That's, another 5, 6, 7 basis percent. That's what you're looking for. You're looking for at least this kind of level in gold over DBC, and that tells me that any dip is a buy. Any dip is a buy. Gold, if it dips, oil will dip twice as much. Let's also look at oil, because I think it has a real chance of trading around these 73 level next week or the week after, and that is where you're supposed to start buying put spreads. I think it's going to turn all the moving averages. I think it's unlikely that it busts 75. But as soon as it gets to the 73 area, I'm going to start buying put spreads, and anything 73.65, then 75.65. I think 65 is definitely going to hold it for quite some time, but these levels are really going to be too much for it, and it's going to go down. That is why, another reason why I think that bond prices are going to get better with time, however much they might be disappointed in the very short term because the Fed's done this or the Fed's done that. I really don't think it matters in the longer term. I think that if all the commodity prices and the oil price are pointing you in one direction, which is the direction of stability of inflation and lower inflation, I really don't think it matters whether the Fed does 25 or 50 now. Inflation is going to target. And if inflation is going to target, then all you're looking for is a spread, a normal spread for real rates over terminal Fed funds. And that should not be much higher than 1.5% at the longer end. Therefore, to me, 340, 350 for a 10-year note is perfectly adequate, possible, and justifiable. Let's start the equities with RPAR, risk parity, and risk parity is still climbing. I still see it at this 2069 level before it's all over. How does risk parity get that? Don't forget, this has gold, it has bonds, and it has equities. I think that basically is going to be mostly done via gold and bonds and very little by equities. I think those charts that I showed you tell me that, and let's go and have a look at it again. We have ITAF over government. This is basically telling me that we're getting some kind of a a rotation, and I would not be surprised if we see ITOT over government in this kind of range with this kind of low 450 against that line, i.e. we are between 456 and 516 for a very long time, and we do some kind of an ABC down. And I mean, I'm not an Elliott wave theorist by any stretch of the imagination, but I just think equities have been doing far too much recently of the heavy lifting that's needed to get ARPA higher, and that it's the turn of bonds. And another 20, 30 basis points at the long end is exactly what the doctor would have ordered. And equities really need to go then sideways and consolidate before we know what kind of a phase we are in. Are we in slightly slower growth, i.e. beautiful soft landing? Are we in a growth recession, i.e. where growth is very close to zero, or between real growth between 0 and 1%? Or are we going to go into a recession, something where we have negative growth and therefore equities actually need to go down? But I don't think we're going to know that for another 3-4 months. So would the natural thing for equities not be to go sideways for a bit and leave leadership to long-term bonds and leave leadership to gold? That is what makes sense to me. I keep on saying that SPX can't really go very far unless there is some kind of a leadership, or at least not resistance, not a headwind from NDX, from the tech sector. And here we are. These are the monthly closes. Okay, I know that September is only just started really, but we are in the middle of September. So if we assume that we close here, it'll be 4 months that it's gone within, what are those? Less than 0.5% from open to close in net change. And while NDX is doing this, how far can SPX go? I.e., how far can the other components push it? Maybe 1 or 2 or 3%. But since this is 35% of it, if the other components go 2-3%, then what's the net on the SPX? 1%, 1.5%? And that is exactly what I think is going to continue. I think the leadership is going to pass on to bonds to get ARPA another 3-4% higher. So let's have a look at SPX. What I would love to see is a spike of the highs, which is 56.68, and then a return back into the range. And then, as I've told you, what makes a lot more sense to me is that people start buying long-term bonds or 10-year notes, let's say, for another 15-20 basis points while this market just goes sideways and stops everyone out that bought it up there, then stops everyone out, that by going back up, when everybody starts getting bearish at this, 54, 47 area. And basically what I can see is a market which moves up and down in a 4, 5, 6% range, fills all the gaps, stops everybody out at the highs, stops everyone out at the lows, and just does nothing for the next 2 or 3 months, which is what nobody's expecting, really. A market which does absolutely nothing, while bonds do slightly better, and ARPA goes up to those levels that I showed you around 23, and we close the year with 10-year notes down at 340, and the equities more or less unchanged exactly here. That kind of behavior, I don't think anybody is expecting. Everybody's expecting equities to lead. I just can't see why they would at this very moment, because the only way that the Fed can justify and not lose the long end, but justify cutting by more than the market would have expected them to cut right now, and then not get the market so excited that it's looking for 50 basis point cuts every Fed meeting, is by lowering the growth estimates, or hiking the estimates for unemployment, and admitting finally that inflation will be at target sooner than their projections. And lower inflation is not great for equities, because equities are always seen as a hedge against inflation. Lower prices of commodities are not great for equities, because they point towards not only lower inflation but also lower growth. So I'm not seeing anything at the moment fundamentally which tells me, oh, I must be long of equities. I'm seeing more things which tell me I should be long of duration and bonds, and far fewer things that tell me that I should be long of equities, certainly US equities. This is EEM over SPY. Now, I know that this chart looks like crap. It completely, there's nothing bullish about it. This is ACWI over SPY, and this is ACWX over SPY. None of those three charts show any bullishness whatsoever. But if the dollar is going to be weaker because differentials in interest rates are coming down, if you are getting not a lot of help from the technology sector in the SPX, and if we are in a period where the US stock market is just going to go sideways as a result of those factors, it makes perfect sense to me, and this is fundamental, it's not technical, that foreign equities should start outperforming US equities, simply because every time that the dollar is weak because interest rate differentials are coming in, it favors the cheaper valuation of foreign equities over the expensive valuation of US equities. Now, what I'm not saying you should do is go in all leverage long one against short the other. But what I'm saying is that at these prices, at this juncture of what the macro is doing, it makes sense to diversify away from the US to some percentage degree. I'm not saying do it leveraged, I'm not saying do it now, I'm saying put a small percentage of your stock allocation and put it in EM, ACWI, ACWX, as opposed to have it all in SPY. And with that, let's see what the Fed does. High level point once again, it has to be justified. Whatever it does, it has to be justified by the summary of economic projections for growth, for unemployment, and for inflation, naturally. Now, you should also watch this Gundlach presentation, not because I think Gundlach is a genius, that's got nothing to do with it, but for the charts, the fundamental charts that he shows. Just like me, he tracks a whole load of spreads, fundamental spreads, which are interesting. And that, to him and to me, concludes that inflation is likely to be below target at some stage in the first or second quarter of next year. And that is why I think that one should now start favoring bonds over equities. I could be completely wrong, but these are all the levels. What we will do on a 25 or what we'll do on a 50 entirely depends on how they justify it. Just know that if they do a 50 and they don't justify it, the yield curve absolutely steepens out of sight. For a start, the market will be looking for 50s at every meeting from now on. Doesn't matter whether it's justified or not, they will be looking for 50s at every meeting. If they do a 50 and they don't change any summaries, you absolutely have to buy the 2-year note, or you have to buy the anything in 2025 in terms of SOFR, because that is what they will be looking for and really pushing for Fed cuts. That will definitely get a big spike in equities immediately. What happens after that is what's going to be interesting, and I think if we get a spike of this 5670 level and it does not hold, that is going to be the high level signal. Thank you very much indeed, and tweet you on Monday.